Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for May 2017. Now, looking at what happened to mid-sized tanker rates in April, they came down again to about $13,000 a day for Aframaxes and about $16,000 a day for Suezmaxes. And that's kind of the lowest rates we've seen at this time of year for probably 4 or 5 years, which is a signal to us that we really are moving into the low point of the tanker market cycle. So the last time rates were this low was back in 2013. Then we saw the strengthening market into 2014, 2015. I think with hindsight, the peak of this last tanker market cycle from a freight perspective was probably late 2015, early 2016. And now we're coming back down into the low part of the cycle, and I think we're going to go into probably the bottom as we go into Q2 and Q3. And really the catalyst for this down cycle have been tanker fleet growth and then also the OPEC production cuts. And so looking at the tanker fleet growth, we've seen about 20 VLCCs, 20 Suezmaxes and about 24 Aframaxes deliver through the first 4 and a bit months of 2017. And we've only seen a couple of ships scrap. So really it's been a lot of fleet growth on the tanker side. And then on the demand side, as I've said, those OPEC supply cuts have come in. Compliance with those cuts has been pretty high, between 90 and 100%. So that's taken a bit over a million barrels a day of oil off the market, and that's really impacted on tanker demand as well. As we go into Q2 and Q3, like I said, usually they're the seasonally the weakest part of the year anyway, and we do expect rates to be pretty challenging in Q2 and Q3. There are some trade factors which I think are looking a bit more positive to offset some of the OPEC supply cuts. Firstly, we are seeing that there's more Atlantic oil moving to the Pacific, which is good for ton-mile demand because of the longer voyage distances. And we're particularly encouraged by US crude production and US exports. We're now seeing some US crude exports going to Europe directly on Aframaxes. We're also seeing a lot of VLCCs now coming into the US Gulf, and what we're seeing is a lot of reverse lightering up to a VLCC so that those ships can go long haul to places like China. In fact, there was a period last month when China took more US crude than Canada. So that's something that we've not seen before, China becoming the largest importer of US crude. We're also probably going to see in the next little while some more exports from West Africa. The Forcados pipeline, which has been offline for a long time, is coming back, so that should mean more exports out of Nigeria. And we're also seeing an increase in production and exports out of Libya again now after some supply disruptions earlier in the year. So the return of Libya and a bit more Nigerian production should produce more cargoes for Aframaxes and Suezmaxes, and that should help offset some of the OPEC supply cuts during the middle part of this year. But really, I think what's having a bigger influence on rates and what will have a bigger impact through the rest of the year is the fleet growth. As I've said, there have already been a bunch of ships delivered in the first 4 months, but there's a lot more still to come through the course of 2017. So there's about 40 Suezmaxes still on order for the balance of the year and about 50 Aframaxes. We might get a bit of slippage, but even so, that's a lot of ships to absorb in a short space of time. So I think it will continue to put pressure on rates through the rest of 2017. The good news is, though, as we get into 2018, that fleet growth really drops off as the order book falls away. And, from sort of 5-6% fleet growth in the last couple of years, I think once we get to next year, we're talking more like 2-2.5% fleet growth, which is going to help the tanker market quite a bit. And then it becomes a question of, well, what's going to happen on the demand side and what's going to happen with OPEC. And our view is that probably through the second half of this year, those OPEC supply cuts will really start to have an impact on global oil inventories. We haven't seen too much movement at the start of this year, but that's probably because there was quite a heavy period of refinery maintenance. Now that refinery throughput is ramping up as we go into the summer months to meet that demand for gasoline, we do think that if OPEC maintains its cuts, which we think it will do at its next meeting at the end of May, then those oil inventories can come down by as much as 200 million barrels through the second half of the year. And that means as we go into 2018, the oil market will be more balanced. And as long as oil demand still grows at a decent rate, 1.2, 1.3 million barrels per day, then we think that even as US production comes up, there will be a need for more OPEC oil. So we think that come 2018, OPEC probably will increase their production again. And we'll still continue to see that Atlantic to Pacific movements as well. So that should be a good demand story at a time when the fleet growth is coming off, which is why we think, again, that 2017 will be the trough and 2018 will be a recovering market, really setting up for what we think will be a much stronger 2019. Once you get to 2019, there's really not a lot of ships on order. We do think as well that there's increased scope for scrapping. You've got a lot of older ships now because there hasn't been much scrapping for 2 or 3 years. And you've got a lot of those late 90s, early 2000 built ships, which as you get towards the end of the decade, will have to go through their 17.5-year intermediate survey and their 20-year fourth special survey. And if those ships also have to put on ballast water treatment systems, it might encourage owners to scrap rather than paying that capex to put the ships through dry dock. So again, we think with increased scrapping, it's looking good towards the end of the decade. Perhaps the only wrinkle now is that we are seeing an increase in tanker ordering. You know, one of the things that we've said before is that for the market to be strong through 18, 19 and 20, we need tanker ordering to remain low. We have seen a number of VLCC orders placed this year, anywhere between 20 and 30, possibly with some more to come, given that some owners have signed some LOIs. But I think that has to be put into context. First of all, we haven't really seen it on the Aframax and the Suezmax side. And on the Vs, I think there is a requirement for just replacement of the old ships. So I don't think it's going to contribute to massive fleet growth once we get into 19 and 20. Of course, a lot of that will depend on what happens in the next 6 to 12 months and whether we continue to see orders. But given that, you know, capital is more scarce these days and shipyard capacity has shrunk a little bit over the last few years, we still feel confident that we won't get the kind of over-ordering of ships that we saw in the last cycle, and that fleet growth will remain relatively low going into the next 2 or 3 years, allowing, as I said, a fairly strong tanker market to emerge as we go into 18 and then further into 19. So that's our update on the conventional tanker market, and we'll talk to you again next month.